Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. And in this session, it's July 2025, I want to get into a second half outlook, which is not something we do formally, but is moving through the middle of the year, a couple of things happen that make it particularly helpful, I think, to take a step back, kind of see where we've come, see where we're headed. And so we're kind of framing that up as a second half outlook for 2025. And the catch line, sort of the punchline here is markets have been resilient. We think that's going to continue. There's some momentum out there, but there's increased downside risk. Now, speaking of risk, the first thing I'll mention is that, we're mindful of a variety of geopolitical risks, importantly, including the Israel-Iran conflict that has calmed down, but a fragile piece, right? So I would just say near the top of our list in terms of potential, the risks that could turn markets lower, sort of a reigniting of those conflicts is right at the top or close to the top of the list. So I just mentioned that. Now, coming back sort of to the U.S., we've talked a lot about the D.C. Transition changes that have happened and are happening. We've got the tariffs and trade policy. We've got now the spending bill that's been passed. We'll get into that. The sort of muted effort of the Department of Government Efficiency, but big changes in Health and Human Services, Department of Education, and immigration policy. And we know that's just created a lot of nervousness, and uncertainty is really the catchphrase that people have been talking about. Now, the good news with regard to the spending bill, One Big Beautiful Bill, OBBB, is that the uncertainty is behind us. The Congress kind of worked through a bunch of drafts, and they got it to a point that everybody was, basically in agreement, and it's been passed. And so, what I want to share with you is just some of the summary changes or extensions that have happened, right? And so the 2017 tax cuts, just at a high level, were made permanent, right? So they were set to expire. Number two, some targeted tax release. So just think of federal taxes on tips over time and auto loan interest may be excluded, and that's for a window of 3 years. Increased the standard deduction and expanded deductions for seniors. And then an increase for a good amount of folks in these state and local tax deduction, SALT cap, from $10,000 to $40,000 for 4 years, 25 through 2029. And so I guess that's 5 years altogether. And yet for that increase, it actually phases out for incomes above 500, and it phases out pretty quickly. And so think of it as, for folks earning less than $500,000 is very good. For a little bit over $500,000, it's good. And then for those that earn beyond that, it's back to the 10% cap. There's certain things that are rolled back in terms of clean energy tax credits from the Inflation Reduction Act. And in terms of spending shifts, basically more money for defense, border security, and ICE, reductions for Medicaid, SNAP programs, and student loan support. That we don't yet have a final assessment by the Congressional Budget Office on the deficit impact, but economists expect the deficits to stabilize around 6 to 7% of GDP, which is a big number. We'll get into that more broadly in just a second. All to say this is stimulative, and there's a view that we're going to see somewhere between 0.3 and 0.5% increase in GDP growth this year and next. And yet longer term, especially with the deficit, we believe that there are some issues that need to be dealt with that go beyond this stimulative spending bill. But there are some potential trouble down the road, which we'll talk about. In any event, when it comes to the markets, think areas that could benefit include tech and industrials. We see some risk with healthcare stocks given the things like the Medicaid changes. And that idea of the deficit and debt, the deficit remaining around and the debt increasing means, the potential for government rates to go up just in terms of investors demanding higher yields. And so, again, a big package. The net of all of it is stimulative in the near term. Now, that'll be supportive of the economy, which has been growing. Another sort of notable thing is retail sales. We just saw another print. And while it's been bouncing around, the latest print was modestly positive. We see sentiment for the consumer, recovering just a little bit. And then the labor market holding up really well. So unemployment rate sits at 4.1%, a couple reference points. The 10 years through February 2020, so think the decade before the pandemic, 6.1% was the average. From the pandemic recovery, that through that period, which we've just marked as May 2020 to December of last year, the average is 4.8. So unemployment's really good. Non-farm payrolls, basically 147,000 is the most recent print. That's June of 2025. The average over that 10-year period I mentioned was 188, and it's huge for non-farm payrolls for that recovery period. So anyway, long story short, just a little bit muted. So that's probably one of the softer numbers. But, the punchline here with quits, that's a metric that's known to gauge almost worker confidence. So the higher the quit rate, the more confident the labor force is. And so that sits at 2.1%. Above the 10-year average through February 2020 by 0.2%, and yet below the higher average from the recovery period of 2.4. So slightly still more confident labor force than pre-pandemic, but not as good as it's been since the reopening. And then finally, job openings. So the JOLTS job openings, I think 7.8 million as of June 2025. The 10-year average through February 2020 is a little over 5 million. And then, of course, the reopening was huge. Over 9 million was the monthly average. So long story short, the labor market is holding up well. And that's important. We'll get into Fed policy in just a second. But overall, the economy, things are holding up. Consensus view is for a growth rate of 1.5%. Keep that in mind as we go forward here. We'll get to our second half outlook in a minute. And so, nobody's really focused on the risk of recession. When it comes to inflation, coincidentally, the week I'm recording this, we had a couple prints, one about CPI and core and PPI and core PPI. And the punchline is, while there was one firm reading, that's the headline CPI coming out for June at 0.3%. Otherwise, things are muted and honestly just sort of hovering around the Fed's 2% target. All to say, between a strong job market, but just a little teeny bit of a sense of maybe some slight softening, but then inflation remaining. The Fed could sit, but market is expecting 2 cuts, one in September, one in December. That's implied in the Fed funds futures rates. And that aligns roughly with what we're thinking, 1 to 2 cuts in the second half. Now, I mentioned the idea of deficit and debt, so we've talked a lot about this, but rates are forecast to remain reasonably elevated. The debt has really grown. The U.S. debt is probably around $37 trillion. It's over a third of our discretionary spending to service that debt. And of course, projections would show that all of that gets worse unless we rein in the deficit. So we continue to talk about, as do many corporate leaders and government leaders, the need to focus on the fiscal trajectory. When it comes to markets, of course, higher yields have created greater opportunities for bond investors. So we're continuing to see pretty high yields across all the different sectors that we invest in. And generally speaking, that's been positive. If we see some Fed cuts, we may see rates fall. When rates fall, bond prices go up a little bit. So that could be a positive as well. In any event, when it comes to the equity market, I mentioned some drama in the first half. It turns out the S&P 500 hit our 2025 initial target of 6,200 on June 30th, so right at the middle of the year. One of the reasons we wanted to provide a little update. And what we all know the story, the Liberation Day, the announcement of tariffs, that really brought the market lower. There was the peak to trough move in the S&P 500 was down 19%. But markets have recovered quite handsomely since then, really, as the markets have essentially shrugged off the worries about tariffs. And we're sitting at a point now where things have recovered. We're still above that level of 6,200 on the S&P. And actually, on a PE basis, we're at about a 21.5% premium to the 10-year average. Now, interestingly, when we look at earnings, there's still a projected earnings growth rate for 2025 of just under 10%, and for 2026, almost 14%. But what I would say is when we look at sort of the pattern of the data, basically April was an interesting month because we had, in the wake of that Liberation Day, a bunch of analysts, and this is really stock analysts, start to adjust their forecasts in a negative direction. So think of it as a good chunk, probably close to or around 75% of the changes were negative. And so that sort of has put a dampening on those earnings forecasts. But interestingly, as folks have sort of shrugged off the worries, we're seeing now the revisions to kind of reverse, and probably the majority of revisions now are positive, especially, and then probably, especially the unchanged. When you add those two together, that's probably, in round numbers, about 3/4 of the cases. So instead of 2/3 or 3/4 negative, it's roughly 3/4 positive or neutral, and only about 1/4 negative. In any event, when we look at market behavior, things like the S&P 500, the financial sector, the Bloomberg 1000 Growth Index, the Magnificent Seven, EFA, that's the developed non-U.S. market, and emerging markets, those have all recovered from the trough back to their peaks. They've made new records in recent weeks. And so markets have done, pretty darn well. Now, just to kind of wrap in terms of sort of framing up our outlook for the second half, there's sort of key assumptions to get us to a soft target on the S&P of 6,500. Now, we don't always do these point estimates, but it's kind of fun to frame it up. And I'll just say that here are sort of the assumptions. The first is tariff clarity, so less uncertainty around tariffs as trade deals get done. Number two is inflation actually, as a result of that, stays reasonably contained. Even with that, then against that, a still solid job market. All that allowing the Fed to carefully but judiciously cut rates maybe a couple of times, 1 to 2 times. We think that leads to GDP at around 1.5%. and that earnings growth of close to 10%. Now, why do we call it a soft target? Partly because there's risks. There's risks around policy changes, the uncertainty around that. There's risk that tariffs kick in and inflation reaccelerates. All of that could lead to the consumer demand softening, or maybe an event like a geopolitical conflict, especially that Israel-Iran situation, all to lead to the potential for animal spirits weakening. And so, the punchline here is we have this generally positive view moving through the second half, but with a recognition that the risks to the downside have increased a little bit. And so we have to be mindful and in some ways ready for that. So anyway, close with a couple comments. One, our long-term investment themes remain a key focus for us, technology innovation, strategic resources for the world, shifting demographics, new ways of consumption happening, and productive competition. And all of this work can be found at stifelinsights.com. Maybe a little plug for those that are listening straight out of the gate. We're going to have a client webinar for the next generation on July 24th. And it's with two actually soccer players, Alyssa and Giselle Thompson, who play for the LA team. Basically, Stifel-sponsored athletes that we're going to have a conversation with. And so again, many of you may listen after it. There will be a replay you can check out. But since that's sitting prominently on stifelinsights.com, go check it out. You can register. And so with that, I appreciate you taking the time to be with us on this session, and we'll look forward to coming back to you soon. Thanks so much.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.